Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Russian economy, and specifically to talk about a report that was published recently by the Stockholm School of Economics. Now, if you're not aware of it, the Stockholm School of Economics is the leading business school in Scandinavia and the Baltics, and they've been studying what's going on since Russia converted to being a wartime economy. Now, we've spoken a lot about this on the channel. Russia has commandeered lots of Russian businesses to help with the war effort in Ukraine. So those companies are receiving guaranteed revenue from the Kremlin to produce things. And this is actually boosting GDP and driving the growth in the economy. But there is a major question as to whether or not that will be sustainable in the long term. And in this report called Financing the Russian War Economy that was published recently, the conclusion, and this is a bit of a spoiler alert in terms of today's video, but I thought it was worth jumping to the conclusion to give you a flavour of the sort of things that this report has covered off, and then we'll dive into more detail on some of these issues. But the conclusion is the increasing vulnerability of the Russian economy. The Russian economy remains relatively stable for the moment, but is on an increasingly precarious footing. While it is superficially resilient, underlying imbalances and structural weaknesses are growing. The fiscal stimulus of the war economy has kept the economy afloat in the short term, but the reliance on opaque financing, distortionary resource allocation, and shrinking fiscal buffers make it unsustainable in the long term. Contrary to the Kremlin narratives, time is not on Russia's side. Continued Western sanctions, military support to Ukraine, and a unified economic front are essential to constraining Russia's war machine and amplifying the economic costs of prolonged aggression. So, quite a damning conclusion here. It's basically saying that what Russia is doing now basically isn't sustainable and is increasingly rising in terms of the vulnerability for the Russian economy. So this basically is saying that what Russia is doing is damaging it for the long term. Now, before we go on any further today, I want to talk to you about today's sponsor, Incogni. One of the things that drives me crazy is spam marketing, whether it be text messages, emails, or my personal pet hate, phone calls, people ringing you up trying to sell you things that you literally don't want. And the reason why you're getting more and more of this is because of data brokers. They can take your personal information and sell it on the internet. So the problem you've got is, how do you stop these data brokers from selling your information? Well, you can actually contact them all individually and ask them to take you off their database. But who's got the time for that? Well, the answer to that is Incogni. Once you sign up with Incogni, they will contact all of the data brokers on your behalf and remove you from their databases. And the great thing is that they'll also protect you from identity theft and cybercrime. And the great news is that you can get a 60% discount off an annual plan, which is what I use, by going to incogni.com/Joe Blogs or clicking in the link in the description below. Now let's look at some of the details, and some of this might be familiar to you if you follow the channel in terms of issues that we've been discussing historically, but there's some interesting points that this report highlights. So this chart, which looks a bit messy, it looks like a toddler's scribbling if you give them 3 different coloured pens, actually plots what's been happening with inflation, which is shown by the blue line, the policy rate, which is basically interest rates in Russia, and the real rate. So that's basically saying what the real rate of inflation actually is. So what we can see here is a complete mess. There's no correlation between these lines in that middle section. So if we look between January 2020 and January 2022, which was in the build up to this war starting, you can see that inflation and interest rates rose over that period, and we're sitting at somewhere around 10%, both before the war started. And that corresponds to what you would expect. Normally, you would expect interest rates and inflation to be somewhere close together, because for most countries, they've got a target rate, and for Russia, it's 4%. It's higher than it is for Western countries because its economy is slightly more emerging and developing than most developed economies. But you can see that the blue line and the orange line are pretty close together in that 2-year period. But what we can see after the war started was there was a huge jump in interest rates the Central Bank of Russia raised the rate to 20% overnight, which they said was an emergency rate to try to keep the economy in check. And we also saw inflation spiking as well in those initial few months. And then we saw inflation coming back down through to 2023, and interest rates were also reduced actually to a lower level than they'd been before the war started. But what we've seen since the middle of 2023 is really quite interesting, because interest rates have now started outstripping inflation significantly. So you can see that interest rates increased from around 8% to the current level of 20%, which is incredibly high. But interestingly, inflation hasn't moved at the same rate. We've seen lower growth in inflation. It actually dropped down to around 2% in the middle of 2023, which was quite puzzling at the time. And as over the last 18 months, 2 years, it's increased to the current level of around 10%. So it's sitting at around half of what the actual interest rate is in Russia. And this report raises a question over that. And if we look at this next graph, what they have done is looked at what's going on with inflation, shown by the blue line, food inflation, shown by the orange line, and then they've plotted what they believe to be the real rate of inflation, looking at the average dating back to 2020. And you can see from that blue line, the lighter blue line, that they are estimating that the real rate of inflation is actually sitting at 20%, which is actually exactly in line with where interest rates are. So this report basically questions the credibility of the inflation data coming out of the Kremlin. They don't believe that the numbers that we are seeing are the genuine inflation numbers. Their estimate is that they think inflation is actually sitting at around 20%. So that's obviously quite a significant change from what we've been talking about historically. Now, in terms of how Russia is funding all of the war effort, a lot of it is coming from the National Wealth Fund. And this report provides a breakdown of the National Wealth Fund that looks into what's been happening with the details. And one of the biggest parts of the National Wealth Fund is gold. Russia does have large gold supplies kept in the Kremlin, reportedly. Nobody really knows where it is, but we know for sure that it wasn't being held overseas, because if it was, it would have been seized at the start of the war, along with all of the other assets that were overseas. Now, if we start off by looking at the blue bar chart at the bottom, that actually shows the amount of gold that Russia is holding in tons. So it's actually the gold bullion that's being hidden in the basement in the Kremlin or somewhere like that. And you can see that at the start of the war, Russia was holding around 500 tons of gold. That actually increased just before Russia launched its invasion to around 700 tons. So clearly from that data, we can see that Russia was gearing up for that. It was moving its assets away from places overseas and bringing it back to the Kremlin, buying gold, basically as a store of value. And it sat at around that level through to the end of 2023. However, since the start of 2024, we can see there's been a big change. There was a drop to less than 500 tons at the start of 24. And over the last 15 months, it's come down significantly. And we are now looking at around 200 tons of gold. So Russia has been cashing in its gold. And if we look at the two lines on this chart, we can see that gold in ruble value is shown by the gold line or the orange line. And you can see what's been happening with that. You can see that spike that went up in 2023. And that was really as a result of gold prices going up. You can see the green line shows the increase in gold. So there's movements upwards. But then as Russia started cashing in its gold, as the tonnage at the bottom goes down, you can see that the value of the gold held went down. We then saw a spike driven predominantly by the increasing gold prices towards the end of 2024. But as Russia has been selling its volume, its actual holdings have gone down significantly. And so in terms of ruble value, it's now sitting at about 1.5 trillion, compared with a peak of over 3 trillion towards the end of 2023. So what this chart shows us is that Russia has been using its gold supplies. It's been cashing in some of that gold, taking advantage of the higher prices in the market to fund the war in Ukraine. But obviously, when you're selling things like gold, once you've sold it, it's gone. And Russia doesn't have the cash at the moment to be able to replenish those supplies. So this is one of the things highlighted in this report as the increasing vulnerability of the Russian economy, because as you realize more and more of your assets, obviously you can't do that forever. You can't just keep funding things from selling all of your gold. Now, in terms of the other part of the National Wealth Fund, it's predominantly held in cash, and that cash is Chinese yuan because Russia is doing a lot of business with China, and China won't deal in rubles. It's refusing to pay for anything in rubles. So it's paying Russia large amounts of Chinese yuan. And because of the balance of trade, Russia's actually selling more to China than it's buying. So it's building up reserves of yuan. So if we have a look at what's been happening over the last couple of years, we've got two different lines plotted on this chart. The blue line shows the exchange rate between the Chinese yuan and the Russian ruble, and that's measured on the scale on the right-hand side, which goes from 0 at the bottom to 16 at the top. And you can see that at the beginning of 2023, one Chinese yuan was trading for around 10 Russian rubles. However, today it's trading nearer to 14. So there's been a deterioration in the value of the ruble. This was at the time of making this report at the start of 2025. Now, if we look at what's been going on with regards to the amount of yuan that Russia is now holding, you can see that at the start of 2023, it was holding around 3.2 trillion rubles worth of Chinese yuan. That increased to a peak of around 3.75 towards the end of 2023. However, since that time, the total amount has fallen, and the current level is sitting at around 2.5 trillion Russian rubles. And one of the issues that obviously is highlighted here is that is despite the fact that the value of the ruble has been falling. So you would have expected the exchange rate, because it's going against the ruble, you'd have expected the equivalent amount of yuan to be going up if Russia had the same amount, because it would be declaring a higher value of rubles. But because it's going down, what that tells us is that firstly, Russia is selling some of its yuan, and secondly, its total amount of yuan that it's now holding is significantly less than it was at the start of 2023. So once again, this report is telling us that the National Wealth Fund is being depleted. Russia is dipping in to its store of Chinese yuan to pay for things, and the longer that goes on, obviously, the less value will be in the National Wealth Fund, and that's increasing the risk from Russia's perspective of running out of cash at some point. And this chart shows the two charts that we've just talked about added together. So we've got the total amount of gold being held in the National Wealth Fund shown by the blue line here. Don't know why it's not the gold one. And the total amount of yuan being shown by the gold or the orange line. So you can see that since the start of 2022, there's been a considerable fluctuation. There was a build-up through 2023 when the National Wealth Fund was actually increasing, and that was predominantly because Russia was cashing in on selling as much oil and gas as it could and trying to store some cash up. However, over the last 18 months or so, we've seen a deterioration in the value of the wealth fund, and it's gone down rapidly since the end of 2024. You can see the sharp drop in both of these lines over the past few months, and that's one of the reasons why this report is highlighting the increasing vulnerability of the Russian economy, because as the National Wealth Fund gets lower, then Russia won't have anywhere to turn to in terms of keeping funding all of the war in Ukraine. Just wants to move on to debt, because highlighted in this report is the fact that Russia is now building up more debt. So as well as funding its war from the cash that it's got in the National Wealth Fund and the gold, it's also borrowing more. And historically, it would have borrowed from the international markets. Before all of the sanctions were put into place, it would have issued bonds and been able to raise money from lots of different financial institutions. However, that's no longer available to Russia because of the sanctions, and particularly the financial sanctions. And the risk, and the increasing risk, is highlighted in this chart. So we've got a number of different things plotted here. So if we look at the green line to start with, that actually shows the amount of debt that's being held, Russian debt, so this is government bonds, those sort of things, being held by non-Russians, so overseas institutions, essentially. So you can see that at the start of 2019, around 15 trillion rubles worth of debt was being held outside of Russia. And by the beginning of 2020, that had actually increased to around 22 trillion rubles. So we can see a upward trend at that point. So there was demand for Russian debt. However, since that time, there has been a complete collapse in the demand for Russian debt from overseas investors. And it's now sitting at around 2 trillion rubles. And if you follow through the trend on this, if we rolled it forward for another couple of years, it's likely that we get to the point where there'd be no demand. The reason why it didn't drop to zero overnight when all of the sanctions were put into place is because a lot of those bonds would have been issued for 10 or 15 or 20 years. So you can't exit the bond. You might be able to if you could sell it to somebody, but the demand for that instrument would have fallen significantly. So institutions face the risk of selling it at basically nothing, or maybe 1 cent on the pound, on the dollar. But so we've got a tail where this debt is sort of trailing off, where it's actually starting to mature. Now, if we look at the other two bar charts on here, the main one, the orange bar chart, shows the total amount of debt. And you can see that at the start of 2019, the total amount of debt that was being held, that was being issued in Russia, was actually around 7 trillion rubles. So, and that's because it was able to raise quite a lot from the international markets. We just talked about the fact that it was like 15 trillion. So in total, it was like 22 trillion. If you add the two together, we've got 7 trillion for the domestic debt and then 15 trillion for the overseas debt. So that's about 22 trillion at that point. But you can see that over the past 5 years, there's been a significant increase. And if we look at the current levels now, it's sitting at closer to 25 trillion, somewhere around 23.5 trillion rubles. So the debt has gone up slightly, but in terms of the shift, in terms of who's owning that debt, it's now being held by Russians. So Russian financial institutions, Russian individuals, they're all now sitting with the Russian risk. And this is another issue that this report has highlighted, that because of that, you've got a double whammy here. If the Russian economy goes into freefall, if it starts to struggle to be able to repay its debt, then the institutions that will suffer and have to bear that loss are financial institutions in Russia. So this would be Russian banks, Russian funds, basically Russian pensions, all of those sort of things. So if Russia defaulted on its debt, then all of those institutions and individuals would be the ones who'd have to pick up the loss. And that could actually make things worse, because that could then dent their profitability, and therefore they may pay less tax, which would drive down GDP. And so this could be a really vicious circle. The ideal scenario here would be that you've offloaded quite a lot of that debt overseas. So in the event that something bad happened, then somebody else picks up the bill. You don't have to worry about all of your own companies and individuals losing money. But what Russia has done here is highlighted the focus on its internal market. So it's increased the risk for its own businesses and its own investors, because they're all investing into Russia and hoping that Russia does well in the long term. So we've got an increase in debt here, but more importantly, we've got a complete shift in terms of who's holding that debt and where the risk is lying. And the risk is now sitting solely in Russia. So that's obviously bad news if things don't go to plan. Now, in terms of what's going on in employment and wages, this chart shows the movement in the rate of employment dating back to 2017. And what you can see here is that we've got a clear downward trend. So back at the start of 2017, unemployment was sitting somewhere around 5.5%, which is reasonably high. It came down to the start of the COVID-19 pandemic to around 4.5. We then saw a spike as a result of the pandemic, and that's similar to what you'd see for every country in the world, because lots of people were put out of work during the pandemic because lots of companies couldn't do anything. So it rose to around 6.5%. But since that time, we've seen a rapid reduction in unemployment, and it's now sitting at less than 2.5%. So if you're looking at the long-term trend here, obviously it's downwards, but 2.5%, whilst you might be thinking, well, doesn't that mean it's a good thing if there's not much unemployment? The problem that you have is that if you don't have enough people in your economy to fill all of the jobs, then you get to a point where unemployment is very low, but actually companies are struggling to hire people because there simply aren't enough suitable candidates to fill all of the roles. And that's the problem that Russia has now. And it's compounded that problem by moving to this wartime economy, because lots of the companies who are being sponsored by the Kremlin, who are making things for the war in Ukraine, are being paid guaranteed revenue and they're getting good margins. So they're doing really well. They're making lots of profit. And they want to fill all of their available jobs, because the more jobs they fill, the more things they can produce, the more money they get paid by the Kremlin. So this is a license to print money for a lot of these businesses. So they've been out recruiting heavily. They've pushed up wages. They basically trying to recruit people from other companies, and that's leaving vacancies in elsewhere in the economy. But the problem is, if you're not a company that's being sponsored by the Kremlin, it's very difficult to compete with those wages, because you're not seeing a 10% increase year on year in your revenue and profits. So the low level of unemployment actually doesn't represent good news for Russia. It tells us that there's now a problem in terms of not having sufficient workforce. Now, if we have a look at what's been going on with wages and pensions, I think this is a really interesting chart. So we've got 4 different lines plotted here. We've got nominal wages, which are shown by the dotted line at the top, and nominal wages is basically the actual wage. We've then got real wages, which takes into account what's going on with inflation. And as we saw earlier in the video, inflation is now running at around 10% officially, although this report claims that it's actually around 20%. So the difference between the dotted blue line and the thick blue line is basically inflation. So you can see that over the last 7 years, nominal wages have increased from around a 6% growth back in 2017 to the current level of around 17%. So that is a rapid increase in wages. That's not sustainable for most economies. What you're getting here is to a point where inflation should be taking off. We should be seeing inflation certainly in the teens, probably in the 20s, when you're paying people 17% more year on year. If you're giving those sort of wage increases, people will spend more money. That will drive up prices, and so we will get inflation. And you can see that real wages are estimated to be increasing by around 10%. So in itself, that's bad news, because if you're being paid 10% above the level of inflation, and inflation is at 10%, then obviously things are starting to get out of control. So that's one of the problems, and it is linked to this wartime economy, because the reason why wages are rising so rapidly is because it's being sponsored by the Kremlin. They're not really looking at return on investment and those sorts of things that a normal business would. They just want the things made to go to Ukraine, and they will pay whatever they need to. Now, interestingly, let's have a look at what's going on with pensions, because pensioners aren't really in the equation here. They're not useful to Russia in terms of what's happening in Ukraine. They're not recruiting pensioners to make things to go to the war effort. And you can see that in the period between 2017 and 2023, there was actually a good increase in the nominal pension in Russia. So back in 2017, it was increasing by around 2.5%, which is probably a global average. That's okay. It's not brilliant, but pensions don't tend to go up rapidly. Between 2018 and 2022, so in the period up until the war started, it increased by around 5%, which is quite generous. I think that most pensioners would be happy with a 5% year-on-year increase. However, between 2022 and 2023, we saw a rapid rise, and it went up by 15%. So nominal pensions increased rapidly at that time. However, in 2024, the increase came back sharply to around 7%. So all of that looks fine, but you've always got to take into account what's going on with inflation. And as we know, inflation is very high in Russia at the moment. And the thick red line at the bottom here shows the real pension. So basically taking into account the increase in prices, how much are you left with from your pension after taking into account the increase that you've been given? And you can see that in 2017, it was actually in negative territory. It's below the zero line. So pensioners weren't being given more money to offset the amount of inflation increase. So in real terms, they had less money in their pockets at the end of each month. Now, in 2018, 2019, 2020, it went into positive territory. 2021, it was around about zero. 2022, which was when the war started, it dropped below the zero line again. It then rose to around 2% in real terms in 2023 and has come back to 0% in 2024. So what this chart tells us is that the Kremlin is focused on trying to get the war sustained. They want to keep things going. They need to send all of that product over to Ukraine. And because of that, they're pushing up wages, but they're not doing anything for pensioners. In fact, pensioners are losing out here. You can see that in real terms, they haven't done very well over the past 3 years. So in the long term, that's going to represent a problem for Russia because it's got an aging population like most developed countries. It's got more people who are living longer. They're becoming pensioners. And so you need to keep the grey market happy. You need to be giving them money to be able to spend to keep the economy growing. So if you were to switch off the war economy tomorrow, the increase in wages that we're seeing in this chart wouldn't continue because we'd probably see a collapse in wages because the companies would no longer be sponsored by the state and it would go back to an openly commercial environment. So they'd have to fend for themselves, and it's likely that we'd see a fall in wages. And the big question is, what will happen to pensions? Will they crash as well? And if they do, then Russia could hit a very deep recession because lots of people would have less money each month to be able to spend, and therefore demand would go down, and so you'd have a struggle maintaining GDP. Now, one of the other things in terms of the debt is what's going on in the property market. And this chart shows what's been happening with mortgages in Russia between the start of 2019 and the start of 2025. The scale on the left-hand side is shown in trillions of Russian rubles. And you can see that back at the start of 2019, the total volume of mortgages in the market was around 6 trillion rubles. However, that has increased significantly over the past 6 years and is now sitting at around 20 trillion rubles. So we've seen a fourfold increase over the past 5 years. And one of the reasons for that is because the price of property has been going up significantly. So if you have a look at this, it shows the housing index in Moscow. So obviously the capital city, the largest city in Russia. And as with all indexes, they start at 100, and this index has been set at the start of 2021. So that's the base level for prices for this table. And you can see that in that 4-year period between the start of 21 and the start of 2025, we've got a significant increase in housing prices. So we've got 3 different lines plotted here. We've got business elite, which are basically high-end properties, so penthouses and really expensive top end of the market. And you can see there's been a rapid increase in the top end of the market, but not as much as the other end, which is interesting. And it's increased from 100 to around 160 over that 4-year period. So that's a rapid increase of 40. If it's going up by 60 over 4 years, that's basically telling us it's going up by somewhere in the region of 15% every single year. That is a rapid growth in house prices. However, it's worse when you look at the general market and then the bottom end of the market. So the bottom end of the market is shown by the green line. So that's the sort of more affordable properties. And then general is the average. And you can see that the general market has increased to around 185. So in a 4-year period, we've got an 85% increase. That is massive. And for the more affordable market, it's actually up to 190. So what this tells us is that house prices have been taking off in Russia. And you can see that since the middle of 2023, we've actually seen really rapid growth. So during the war in Ukraine, the market has taken off. And that's partly because there's been a lot of stimulus measures in Russia. They've been trying to promote the economy. They've been offering low-cost mortgages to people, so basically discounted mortgages that you can get from Russian financial institutions. And when you can get cheap debt and lots of it, you'll then borrow and go out and spend. And that's when you drive up competition. If everybody can borrow lots of money, you can afford to pay more for a house. That's what's been happening. The prices have gone up. But the problem that you have when prices spike like this is that if you do go into recession, if things do start to slow down in the economy, as has been suggested in this report, if the wartime economy stopped, for example, then it's likely that people would be paid less. There is then a big question as to whether they can continue affording their mortgage. If they can't, they might have to sell, and you could see a crash in property prices. That's the problem when you have such rapid growth like this, is that it can be boom and bust. So, what's the summary and conclusion today? Well, I wanted to post this video because I think this report produced by the Stockholm School of Economics is really quite interesting. And it's also independent research because I make a lot of videos talking about Russia and I get a lot of comments from people saying, you're making all of this up, you're completely wrong, you're talking nonsense, no, stop making videos. So, I like to go to independent analysis if it's available and see what other people are saying. And what we've seen in today's video is very similar to what we've been discussing over the last 18 months or so. Since Russia converted itself to being a wartime economy, really focusing in on keeping the war effort going and commandeering lots of businesses, thousands of different businesses in Russia are now being paid guaranteed revenue by the state directly from the Kremlin to produce lots of different things. And that's provided a real boost to the economy because those businesses are now thriving. They've never had it so good because they don't have to worry about marketing and product development and all of the things that comes along with having a normal business. All they need to do is hit their targets in terms of what they're being asked to produce, and they know that that money is going to be guaranteed to them from the state. So this is happy days for a lot of those businesses, and they've gone out and recruited heavily. They've filled all of their vacancies by offering higher and higher wages. The problem with that is that if you're a company that isn't involved in the war effort, if you're not being sponsored by the state, then you're seeing your staff leaving. They're walking out the door to go and work for these state sponsored companies. And you're then having to offer higher wages as well to compete and try to recruit people back into your business. But unless you've got 15 or 20% increase in revenue, you can't afford to pay a 15 or 20% increase in wages, which is what's been happening as we saw from the data. So those companies are really struggling. We've got a total imbalance here in the market, and that's highlighted in this report, that lots of businesses are being sustained directly by Russia, and the other businesses that aren't are really now in difficulty. They are struggling. So they're taking on more debt as well to fund their losses and to fund hiring all of these people and all the investment that they have to make into their businesses. But in addition to what's going on with the war economy, we've also seen in today's video that Russia has been using its national wealth fund to keep the war effort going. It's had to dip in and sell Chinese yuan and sell gold in order to fund all of the difference between the revenue that it has and what it's costing for the war in Ukraine. And that is not a sustainable position. It's basically like you raiding your savings. You can do it. You can go into your savings and keep spending, spending, spending. But at some point, those savings will run out. And at that point, you're going to be in a world of pain, particularly if you've taken on a lot of debt. And that's exactly what Russia has been doing. We've seen that it's been taking on more debt. It's increased the amount it's borrowed. And the shift of that debt has gone to the Russian people and Russian institutions. So Russia has now increased its own risk. Those institutions and people are at risk of losing money if Russia gets to the point where it can't actually afford to keep servicing or repaying its debt. So the risk profile for Russia and its investors has gone up at a time when its borrowing has also gone up, its savings have gone down, and the cost of everything in the economy is going up. And what we also saw in today's video is that there was a big question mark from that report as to whether or not the inflation data that's being published by the Kremlin is genuine. They don't believe that you can have 10% inflation when interest rates are at 20%. You usually would expect them to be somewhere in correlation. And in this report, they believe that inflation is actually sitting closer to 20% than it is to 10%. And if that's right, then what we are seeing is a spiral in Russia because prices are going up, wages are going up, debt is going up, house prices are going up, mortgages are going up, and all of this is increasing the risk for Russia. And if the war in Ukraine was to stop and the wartime economy came to an end, we could see an implosion of the economy because if all of those businesses lose all of their guaranteed revenue from the Kremlin, they might have to start releasing people, firing people. People then would be struggling. They'd have to try and get more jobs. Wages would drop like a stone. People would be paid less. That throws a question mark as to whether or not they can afford their mortgages. If they can't afford the mortgages, people might be selling property. If there's a flood of properties onto the market, that would reduce house prices. And all of this could result in a complete disaster for the Russian economy. So hopefully you've enjoyed today's video. You found it useful, informative, and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and thank you so much to everyone that's supporting me. If you've bought me a coffee or sent me a YouTube super thanks, really appreciate that support. And if you're a long-term supporter, either through Patreon or YouTube membership or Buy Me a Coffee membership, thank you so much. Really helps to keep me motivated. And here's something to put a smile on your face.